Welcome to Breaking News to Trading Moves.
Good to be here.
So today we're looking at the market reaction, the implications from that recent AMD AI Analyst Day, advanced micro devices.
Right. That event, it definitely got people talking. The main headline was CEO Lisa Su. She gave this really confident outlook on AI demand.
Calling it insatiable, wasn't that the word?
That was the word, insatiable. And off the back of that, they boosted their estimate for the AI total addressable market, the TAM.
Yeah, I saw that, to over $1 trillion by 2030. That's a massive number for this space.
It really is. And you saw the effect almost immediately, didn't you? The stock ticker AMD
AMD, right.
pumped about, what, 10%?
Yeah.
And it seemed to lift the whole semiconductor index a bit, too.
It did. So our mission today, for you listening, is to figure out what this kind of high-demand picture suggests for different tech sectors. If that trillion-dollar TAM plays out, even partly, where's the money likely to flow?
Exactly. We're looking at the potential winners and, well, the flip side, the potential losers, based on how analysts are reading this outlook.
And we should probably frame this, right? This insatiable demand idea, it kind of forces a debate.
It does. You hear analysts asking, does this mean we're really in an AI supercycle? Years of massive investment needed.
Or is it the other way? Does it maybe suggest things have gotten a bit too hot, too fast, maybe pointing towards an AI bubble down the road?
Precisely. And both those viewpoints, they're influencing how money is moving right now.
Okay, so let's dig in. Let's start with the companies that seem best positioned if this trillion-dollar market actually starts taking shape. Group one seems obvious. The AI chip leaders and accelerators.
Yeah, that makes sense. The thinking here is pretty direct. If the market's going to be that big, it just reinforces what we already kind of know. Data center AI chips, they're supply constrained.
Seriously constrained. It's not just about making enough silicon wafers, is it? It's the complex stuff, too.
Right, like the advanced packaging needed to actually get that high bandwidth memory, HBM, stuck onto the processors effectively. That's scarcity. It keeps pricing power strong for the top players.
For the ones making the really high-performance gear.
Exactly. So that puts advanced micro devices, AMD obviously, and NVIDIA, ticker NVDA, right in the spotlight.
Okay, NVIDIA.
Yeah.
Makes sense, given their current dominance in the whole CUDA ecosystem.
For sure. And for AMD, well, this kind of forecast helps justify the huge amounts they're spending on their MI300 series chips and whatever comes next. It makes them look like a really solid second source, potentially high volume.
All right, so you've got the chip makers, but someone has to buy all these expensive chips.
Which brings us neatly to group two, the hyperscale cloud and data center builders.
The big cloud providers.
They are, hands down, the biggest buyers of these high-end AI chips, period. So if you believe in a long, multi-year AI build-out,
Then they have to keep spending heavily.
right, sustain investment in GPU clusters, the special networking that ties them together, the massive power infrastructure needed just to run the things for training and inference.
So we're talking Microsoft, ticker MSFT.
MSFT, yeah. Amazon, AMZN,
AMZN, and Alphabet, GUGL.
GL. They're the ones signing those huge purchase orders with NVIDIA and AMD.
But wait, is this purely a winner thing for them? I mean, doesn't spending billions on infrastructure potentially squeeze their profits, at least short term? That's a lot of capital expenditure, CapEx.
That's a really fair question. And the analysis acknowledges it. It's definitely heavy on the CapEx side. But the argument for them being winners is, well, twofold.
Okay.
First, they build customer loyalty,
Yeah.
right? They offer these unique AI services others can't easily replicate. And second, their cloud businesses, Azure, AWS, Google Cloud, they keep growing strongly, partly because AI needs that kind of scale.
So spend a lot now to lock in the big revenue streams for the next 10 years or so.
That's the rationale, basically. They're building the essential AI infrastructure, the utility, you could say.
Okay, that makes sense. Building the utility. But that utility needs more than just the brains, the processors. It needs pipes, right? Which takes us to group three, AI infrastructure, networking, and memory suppliers.
Correct. A $1 trillion AI market needs a whole specialized ecosystem inside the data center. It's not just the compute chip, it's everything connecting it.
The veins and arteries, like you said.
Yeah.
So that means big steps forward in things like high bandwidth memory, HBM.
Which we mentioned, yeah, crucial.
Advanced packaging tech, super fast networking chips, all the connectivity to handle the flood of data moving between potentially thousands of GPUs.
Absolutely. So the companies providing that underlying tech, they become essential beneficiaries too. Think Broadcom, ticker AVGO.
AVGO. Right. They do a lot in high-end networking, especially for connecting GPUs within a cluster, right?
Yep.
And custom chips, too.
Exactly, and custom silicon ASICs for the big cloud guys. Then there's Marvell Technology, ticker MRVL.
MRVL, similar space. Data infrastructure, connectivity.
And Micron Technology, ticker MU.
Ugh, Micron, MU. Memory. They're perfectly placed for HBM, aren't they?
Perfectly placed. They're a key supplier of that high-margin HBM that basically every top AI chip needs. So when AMD throws out a trillion-dollar number, these infrastructure players see their own potential market expanding like crazy.
Okay, so those are the potential winners based on this outlook. Now let's flip it.
Right. If AI is seen as the main growth driver and building it takes so much capital, where might investors start pulling money from? Where could we see relative underperformance because everyone's chasing AI?
Good question. That leads us to the first group of potential relative losers, legacy PC-focused hardware and non-AI-centric chips.
Yeah, the logic here is pretty straightforward capital rotation. If the AI story is priority number one for investors.
Money moves away from the maybe less exciting areas.
Exactly. Away from commodity segments or slower growth spots tied mainly to, say, traditional PC sales or older ways of processing data.
So the idea is companies really dependent on those old product cycles might lag behind the AI plays, even if their core business is okay, profitable even.
They just aren't part of that big growth narrative the market's currently focused on.
So who falls into this category?
Well, names that come up often are Intel, ticker INTC.
INTC. Okay, they're trying to build an AI story, but still heavily reliant on PCs and standard server CPUs.
Very much so. And HP Inc., ticker HPQ.
HPQ, focused on PCs and printers, right?
Right. If the market focus is laser sharp on $1 trillion in AI, it's just tougher for these kinds of companies to capture that same investor excitement.
Okay. Now, the second category of potential losers, this one feels a bit tricky. High multiple AI momentum names, vulnerable to bubble fears.
Wait, how can the winners also be vulnerable?
It's all about valuation versus the actual execution. Even if demand is insatiable, like AMD says, what if growth slows down just a bit? Maybe AI spending doesn't keep accelerating at this pace in, say, 2 or 3 years. Or maybe just market sentiment sours quickly.
Then the stocks that have run up the most get hit hardest. Exactly. Those highly valued companies that have basically priced in perfection, years of flawless execution, endless growth, they could see really sharp drops. There's just no room for error baked into their stock price.
You mean the ones that have had those astronomical climbs based mostly on future promise, like Supermicrocomputer, ticker SMCI?
SMCI is a classic example. They make specialized servers for AI, they've soared, but that valuation assumes they just keep grabbing more and more market share nonstop.
Okay. And ARM Holdings, ticker ARM?
ARM is another one. Yeah, their licensing model means they touch almost every chip, which is great, but the valuation is, well, pretty stretched.
So if AI chip deployment maybe doesn't quite meet those super high expectations, or the licensing money doesn't grow as fast as people hope?
Then these high flyers, the high multiple names, they become the first place investors look to take profits or reduce risk. They're vulnerable to a sentiment turn.
Got it. Okay, final group of potential losers. Traditional enterprise IT vendors crowded out by AI capital expenditure.
This is that classic zero-sum budget problem, right?
How so?
Well, think about a big company's IT budget. If they suddenly need to allocate massive funds to building out AI infrastructure, buying all those GPUs and related gear.
That money has to come from somewhere else in the IT budget.
Often, yes. The concern is that spending on legacy stuff, things not directly related to AI, gets delayed. Or maybe even cut.
Like what kind of spending?
Think about regular hardware refreshes for servers already running in their own data centers, standard network upgrades, maybe licenses for traditional business software. If you have to spend millions on new AI servers.
You might just try and squeeze another year or two out of your existing older standard equipment.
Precisely. You freeze spending there or extend the life cycle, and that puts pressure on the big vendors who rely on those predictable enterprise refresh cycles.
Companies like?
Like International Business Machines, IBM.
IBM, okay.
And Cisco Systems, CSEO.
CSEO. Their traditional businesses are really tied into those standard corporate IT budgets, right?
Very much so. So they could face headwinds if more and more of that corporate IT spending gets redirected specifically towards AI projects instead of routine maintenance and upgrades.
Okay, so let's try and pull this together. The AMD Analyst Day, it dropped this really bold forecast. a $1 trillion TAM for AI by 2030. And that definitely stirred things up in the tech sector immediately.
For sure.
Yeah.
And based on how analysts are looking at it, we've identified roughly 12 companies split into winners and potential relative underperformers.
Right. From the chip makers like AMD and NVDA, the cloud giants like MSFT, AMZN, GeoGL, and the infrastructure players like AVGO, MRVL, MU.
To the potential laggards like legacy players INTC and HPQ, the high-flying but potentially vulnerable names like SMCI and ARM, and the traditional enterprise vendors like IBM and CSGO who might get squeezed.
So we'll leave you with this thought, this core tension that comes out of the analysis. If we take AMD at their word, that AI demand is truly insatiable. What hits the market first?
Is it the slow, steady, maybe decades-long build-out required to actually reach that trillion-dollar market reality?
Or is it the more immediate, maybe short-term nervousness about an AI bubble possibly forming, especially among those stocks that have already run up so much?
Yeah, that tension, that's really defining the trading environment right now.
Definitely something to think about.
And one last thing, a necessary point. Please remember, the information we've discussed here comes purely from analyzing that reported outlook and the market's reaction from the material we reviewed.
Absolutely. This is not financial advice. It's not a recommendation for you to buy or sell any specific stock.
These projections, these classifications of winners and losers, they are simply the opinion of the author of the text that was analyzed. Do your own research.